Sir, please start.
Good afternoon.
Please start.
Good afternoon to all. Today we will discuss about return of income, and if time permit, then we will move forward for assessment procedure. First of all, we will start with return of income. What is return of income? Every year, the assessee is required to furnish return of income. Who is required to furnish return of income? Each and every person. Filing of return of income, it is governed by section 139. Ideally, if you are a company or a partnership firm, irrespective of your size of income, you are required to file return of income mandatorily. However, if you are a trust, political party, scientific research, association, etc., then you are supposed to file return of income if your income without considering exemption available to them, if their income exceeds basic exemption limit, then they are supposed to file return of income mandatorily, else it is optional for them. Next, university, business trust, investment fund, etc., irrespective of size of their income, they are supposed to file return of income mandatorily. That means in case of company or partnership firm, university, business trust, investment fund, etc., they are supposed to file return of income mandatorily, whatever be the size of their income. It may be a loss case, it may be income, whatever be size of income, they are supposed to file return of income mandatorily. However, in case of trust, political party, scientific research association, etc., if their income without considering exemption given to them, if their income exceeds basic exemption limit without considering exemptions available to them, their income exceed basic exemption limit, they are supposed to file return of income mandatorily, else it is optional for them. For other person like individual HUF like me and you, we are supposed to file return of income without considering deduction available under chapter 6A and without considering deductions available under 54 series, which is available from capital gain. If my gross total income without considering deductions available under 54 series exceeds basic exemption limit, then I'm supposed to file return of income mandatorily, else it is optional for me. For example, my gross total income is 3 lakh. I'm eligible for deduction under section 80C amounting to rupees 1 lakh. My total income would be 2 lakh. Am I required to file return of income? Am I required to pay tax? My tax liability would be 0. So I'm not liable to file any return of income? No, the answer is no. Your liability to file return of income and your liability to pay tax are two different things. There are different conditions. If your gross total income, without considering deduction under 54 exceeds basic exemption limit, then you are supposed to file return of income mandatorily. In this case, your gross total income, what is the gross total income? That is total income without considering your deduction under chapter 6A. That is gross total income. If your gross total income exceeds basic exemption limit, then it is mandatory to file return of income in case of individual or HUF. Irrespective of the fact, my tax liability would be 0. I'm not liable to pay tax. I'm supposed to file return of income mandatorily. Is it clear? One more thing. Gross total income without considering deduction under section 54 series. For example, my income consists of my business income, say 2 lakh. I'm liable for my income capital gain is say rupees 3 lakh. And on the same time, I'm eligible for deduction under section 54 amounting to rupees 2,50,000 and my other sources income is 1 lakh. I'm liable for 80C, eligible for 80C amounting to rupees 1,50,000. So my total income would be my total income would be 3,256 and 250. I'm not required to pay any amount of tax, but just recalculate your gross total income. My gross total income would be this one, 566 minus 2.5, that is 3.5. Without considering this deduction, my income would be my gross total income would be 6 lakh. So it is more than basic exemption limit. I am supposed to file return of income mandatorily. Clear? What is the basic exemption limit in case of an individual? If he is a senior citizen, then it is 3 lakh. If it is a super senior citizen, then it is 5 lakh. In other case, it is 2,50,000. However, if you are opting for 115 BAC, that is new tax regime, then your basic exemption limit would be 2,50,000. If your gross total income without considering deduction available under section 54 series exceed basic exemption limit, depending on the regime you are opted, exceed this basic exemption limit, you are supposed to file return of income mandatorily. Done. However, in certain cases, a resident person is required to file return of income mandatorily. The reason behind this is that assessing officer want to verify whether you are claimed for deduction, whether you fulfill the condition provided under for claiming these deductions are fulfilled or not. That's why they are asking to file return of income without considering deduction under chapter 6A and without considering deduction under section 54 series. That's why it will enable assessing officer to verify or to check whether you fulfill the condition, respective conditions for fulfilling for those deductions or not. If you did not file the return of income, how assessing officer will verify whether you are the conditions against which this deduction is available are fulfilled or not. Compulsory filing of return, case 1. If you are a resident person, if you are an ordinary resident person, then you are supposed to file return of income mandatorily if you hold any asset, any bank account in outside India. If you hold as a beneficial owner or otherwise any asset, including any financial interest in any entity which is located outside India, or you are a signing authority in any account which is located outside India. If you are a beneficiary of any assets which is located outside India, you are supposed to file return of income mandatorily. For example, suppose Mr. X is claiming that his income is only 1 lakh per annum and he is holding his bank account in Swiss. In a Swiss bank, he is holding an account. A bank located in Switzerland, he is holding an account. Do you think a person who is earning rupees 1 lakh per annum holds a bank account in Switzerland? It is not possible. The government want to verify how it is possible. In this situation, this person is required to file return of income mandatorily, irrespective of size of his income. Even though his size of income does not exceed basic exemption limit, he is required to file return of income mandatorily. Compulsory filing of return, case number 2, 7th proviso to sections 139(1). Here, certain economical criteria are mentioned. If any of the criteria are fulfilled, then a person other than firm or company is required to file return of income mandatorily. If any of the criteria given under 7th proviso is fulfilled, then you are supposed to file return of income mandatorily. First criteria is that in one or more current account during the year, you have deposited rupees 1 crore or more than 1 crore rupees in one or more current account. Aggregate deposit in current account exceed 1 crore, maybe in cash, maybe in account pay check, maybe through RTGS, maybe through IMPS. If total deposit in one or more current account in a particular year exceeds rupees 1 crore, you are supposed to file return of income mandatorily, irrespective of your size of income. Similarly, if you incurred foreign travel expenditure for himself or for any other person, if you bear the foreign travel expenditure more than rupees 2 lakh, you are supposed to file return of income mandatorily. Further, if during the previous year you incurred more than rupees 1 lakh as a towards consumption of electricity, you are supposed to file return of income mandatorily. Number one, again, I am repeating, if someone deposited more than 1 crore rupees in one or more current account during the previous year. Number two, if you incurred foreign travel expenditure for himself or for any other person exceeding rupees 2 lakh during the previous year. If you have incurred electricity expenditure exceeding rupees 1 lakh during the previous year, you are supposed to file return of income mandatorily, irrespective of size of income. Number D. Now, in this D clause, Act suggested that board have power to provide some more condition on those your you are supposed to file return of income mandatory. Considering this clause, board means Central Board of Directors provided this four criteria to file return of income mandatorily. If your total sales turnover exceeds 60 lakh during the previous year, you are supposed to file return of income mandatorily, irrespective of size of income. If you are doing the profession and your gross receipt from the profession exceeds 10 lakh, you are supposed to file return of income mandatorily. If TDS or TCS has been deducted or collected on your behalf exceeds 25,000, then is 25,000 or more, you are supposed to file return of income. In the case of senior citizen, if the amount is 50,000 or more, then you are supposed to file return of income mandatorily. Similarly, if you are holding saving bank account and aggregate deposit in saving bank account or accounts exceeds 50 lakh or more during the previous year, you are supposed to file return of income mandatorily. In this 7 situation, irrespective of size of your income, you are supposed to file return of income mandatorily. And when you are supposed to file return of income, under which form you are supposed to file return of income, we are going to discuss further. Till now, any query, any question? Neetaji, yes, deposit of 1 crore include cash and non-cash item. Even if you deposited through cash or deposited through RTGS, NEFT, if the aggregate total of credit deposit into the current account exceed 1 crore rupees, you are supposed to file return of income mandatorily. The Act, the rules prescribed 7 ITR. 7 ITR form, income tax return form are 7. You are supposed to file one of them. It is not like that all of the return you are supposed to file. You are supposed to file one of them which is applicable on you. Which form is applicable on you? You are supposed to understand this one. Say, in case of company other than company which is claiming exemption under section 11, that is related to trust. In case of company, you are supposed to file return of income in ITR 6. In case of company, other than companies which are claiming exemption under section 11, you are supposed to file return of income in ITR 6. In case you are a charitable trust, university, etc., you are supposed to file return of income in ITR 7. Apart from individual and HUF and these persons which are covered by ITR 6 and 7, you are supposed to file return of income in ITR 5. That means a person other than individual, HUF, company and any person who are required to file return of income in ITR 7 are required to file return of income in ITR 5. Can I say that a partnership firm is supposed to file return of income in ITR 5? LLP is supposed to file return of income in ITR 5. AOP, BOI are required to file return of income in ITR 5. Now comes to individual and HUF. In respect of individual HUF, they are suggesting four forms. Apart from even not form, for individual, they are suggesting four ITR form. For HUF, there are three forms. For individual, having business income. For individual and HUF who have business income are supposed to file return of income in ITR 3. This is the one of the complete form for individual or HUF SSE. If you are an individual or you are an HUF and have business income, business or profession income, you are supposed to file a return of income in ITR 3. However, if you are offer your business income under presumptive provisions, that is 44AD, 44ADA and 44AE, then you may file your return of income in ITR 4. This is also known as SUGAM, provided your income does not consist of capital gain. Your income does not contain capital gain. That means you have business income and you are offering business income under section 44AD, 44ADA and 44AE, and you do not have capital gain, then an individual or HUF may file return of income in ITR 4. If you have business income not offering your income under this presumptive provision, or you have business income as well as capital gain, you are supposed to file return of income in ITR 3. If you do not have capital gain, if you do not have business income, then an individual or HUF is required to file return of income in ITR 2. If an individual or HUF does not have business income, they are supposed to file return of income in ITR 2. That means depending on nature of income, you are supposed to opt which form is applicable on you out of 1, 2, 3, 4. Then accordingly, you are supposed to file return of income. I'm repeating, in case of company SSE, you are supposed to file return of income in ITR 6, provided the company is not claiming any exemption under section 11. If you are a charitable trust, you are a business trust, you are a trade union, you are a university, you are supposed to file return of income in ITR 7. Any other person apart from individual HUF company and person required to file return of income in ITR 7 is supposed to file return of income in ITR number 5. For individual or HUF, there are four forms: 1, 2, 3, 4. If an individual or HUF have business income, they are supposed to file return of income in ITR number 3. However, if that person offer business income considering presumptive provision covered under section 44AD, 44ADA and 44A and does not have capital gain, they may file their return of income in ITR number 4. If they have capital gain or their business income are not covered under section 44AD, ADA and 44AE, they are supposed to file return of income in ITR number 3. However, if individual or HUF does not have any business income, they may file return of income in ITR 2. They are required to file their return of income in ITR number 2. However, one form is more are there, ITR 1. It is known as Sahaj. ITR 4 is known as Sugam and ITR 1 is also known as Sahaj. This ITR 1 is one of the smallest form. Lesser informations are required to be filled. You are supposed to file ITR 1 if certain riders, certain conditions are simultaneously fulfilled. That is, all conditions are required to be fulfilled, then you can file your return of income in ITR 1. Now, what are the conditions? Condition number 1, you are a resident individual. You are an ordinary resident individual. If you are not an ordinary resident individual, you can't file your return of income in ITR 1. Condition number 1, you are a ordinary resident individual. That means ITR 1 is not made for HUF. You are an ordinary resident individual. Number 2, your income consists of salary, one house property, and income from other sources like interest, dividend, family pension, etc. Your total income does not exceed 50 lakh. Your total income does not exceed 50 lakh. Three condition. Number four, your agricultural income does not exceed 5,000. Your agricultural income should not exceed 5,000. Number five, you are not a director in any of the company. Number six, you are not holding any shares in an unlisted company. You are not holding any share, any equity share in any unlisted company. And number seven, no carry forward or no brought forward losses are there. There are no carry forward and brought forward of losses. Then if all these conditions are simultaneously fulfilled, then only you can file your return of income in ITR number 1. I am repeating again, what are the conditions? All of these are required to be fulfilled. Then only you can file your return of income in ITR 1. Number one, you are an ordinary resident individual. Number two, your income consists of salary, one house property. One means you have only one house property. If you have two house property, you cannot file your return of income in ITR 1. Your income from other sources may be consist of individual interest, dividend, family pension, etc. That means your income should not consist of lottery income, where a special rate of income tax is applicable. That income should not form part of your total income. Number third, total income should not exceed 50 lakh. Number four, your agricultural income should not exceed 5,000. Number five, you are not a director in any of the company. Number six, you does not hold any equity shares of any type of unlisted company. Number seven, you may hold shares of listed company, but you should not hold any equity shares of unlisted company. It may be private or public, but that company is unlisted. Then if you are holding the equity share of those company, you cannot opt for ITR 1. And the last one, the case your total income, your computation does not include carry forward of losses or brought forward of losses. If all these seven criteria are meet, then only you can file return of income in ITR 1. Is it clear? I have one example for you. Sometime your question in examination, it may be asked like this one. Suppose Mr. X, ordinary resident, having salary income of rupees, say 65 lakh, say interest income on saving bank account is rupees 2 lakh, in which ITR he is supposed to file return of income. In which ITR he is required to file return of income. Is it ITR 1? Is it ITR 2, 3, 4? Examine this situation. Since there is no business income, ITR 3 and 4 is not applicable. For ITR 1, income consists of salary, interest, okay, fine. He is ordinary resident, fine. But his income, total income exceed 50 lakh, hence he cannot file return of income in ITR 1. So which ITR he is required to be used? He is supposed to file his return of income in ITR number 2. In ITR number 2. One more example. Suppose Mr. X, salary income 30 lakh, income from house property, one house property, minus 2 lakh, in which ITR form he is supposed to file return of income. In this situation, again, he may file return of income in ITR 1. Why ITR 1? The loss of house property shall be adjusted with salary income. Hence, the question of carry forward or brought forward of losses does not arise. He may file return of income in ITR 1 provided all other conditions are fulfilled. Prima facie, all other conditions are fulfilled. One more example. Mr. X, his salary income is 30 lakh. His income from house property, from one house property, is loss 5 lakh. In which ITR he may file return of income? How does this 5 lakh arise? It is not mentioned that that particular one house property should be self-occupied. The one house property should be are covered under ITR 1. It may be self-occupied, it may be let out. In case of let out house property, loss may be of 5 lakh is possible. In case of self-occupied property, loss maximum loss possible is only 2 lakh. However, in case of let out property, any number may be there. So this is the situation in which ITR he is required to file return of income. Is it ITR 1? Is it ITR 2? Is it ITR 3? In which return form he is supposed to file return of income? ITR 3 is not the best choice because his income does not consist of business income, so it is not possible. Now comes to ITR 1 or ITR 2. Anyone? In this situation, which form is required to be filed? In this situation, he cannot file return of income in ITR 1. Why? That reason is that in case there is a loss under the head income from house property, he can adjust his loss up to rupees 2 lakh with salary income. Remaining loss from under the head house property is required to be carried forward. In case of ITR 1, the one of the criteria is that the loss carry forward and brought forward are not should not be there. In this situation, loss of 3 lakh under the head income from house property is required to be carried forward. Since this is the case of carry forward of losses, ITR 1 is not possible. Only possible ITR is ITR number 2. Done? Any question? Any question? Yes, Manitaji, you are very correct. HP set of loss 2 lakh and 3 lakh is required to be carried forward. So he cannot file return of income in ITR 1. If an individual are having two house property, he cannot file return of income in ITR 1. In that situation also, he is required to file return of income in ITR 2 or ITR 3, depending on nature of other income. Any other question? Now, one form are also there called ITR-V. That V denotes verification, but it is does not any income tax return. It is mere a verification form. I will discuss this part on sometime after some time. Few more restrictions for the purpose of filing return of income in ITR 1 and 4 are: you cannot claim relief under section 90, 90A and 91. What is this relief? DTAA. If an individual is claiming relief under double taxation avoidance agreement, he cannot file return of income in ITR 1. If the person is required to file return of income mandatorily due to the reason he is holding any asset or any bank account located outside India or having any income which is from a source which is located outside India. In that case also, he cannot file return of income in ITR 1. In that situation also, he is required to file return of income in ITR 2 or 3. Why the restriction of 5,000 is there regarding agricultural income? Is there any reason? Is there any reason why the restriction of 5,000 regarding agricultural income is there? We all know that if my agricultural income exceed 5,000 and my non-agricultural income exceed basic exemption limit, in that case integrated computation is applicable, which is technically little bit tough. So in this ITR 1, they are trying to keep it very simple, no technical, no complicated calculations are covered. So they does not consider capital gain, So they does not consider lottery income. So they does not consider lottery agro income more than 5,000. So the calculation remain very simple. It is one of the very simplest form. ITR1 is one of the very simplest form. So the things are required to be keep simple. They bypass all this nature of income. Mode of filing return of income. Altogether, there are four modes of filing return of income. A person may file return of income in four ways. Number one, it may be paper return. That means take a hard copy of the return, fill it, and submit to the income tax department. One of this is uses of paper return are very less nowadays. Earlier, it may be used, but nowadays electronic returns are there. You may file return of income through electronic way with digital signature, electronic return with ITRV, electronic return with EVC code. There are four modes to file return of income. Number one, paper return. Number two, electronic return with digital signature. Number three, transmitting the data in the return electronically. That means you file e-return and then verify it through ITRV. And one more option, transmitting the data electronically. That means you filed return e-return and verify through EVC code. What is digital signature? Electronic return with digital signature. What is EVC code? What do you mean by EVC code? EVC code is nothing but OTP. Generally what happened, paper return, you can sign on the return. You can verify the data details furnished by you by putting your signature on the paper on the hard copy of the return. That's why verification is possible. In electronic filing, verification is a challenge. So they suggested this three way. One of them is a file return of income electronic mode with digital signature. That means verification is done through digital sign. Next, you do not have digital signature. In that situation, you may file your return of income electronically and generate an ITRV, generate an AD, take a printout of the single page AD called ITRV. Take a printout of this ITRV, put your signature and send this ITRV, signed ITRV to the CPC Bangalore within 30 days of filing electronically. Be careful. You should send this ITRV by speed post or by ordinary post. Do not use courier. Within 30 days, this ITRV, signed copy of ITRV, should be reached at CPC Bangalore. Then the process of filing return of income is completed. If you file return of income electronically but does not verify this either of the mode, then we will consider you did not file any return of income. For the next one, furnish your return electronically. That means transmit all the data electronically, e-file, and then use EVC code. EVC is nothing but OTP. Generally the mobile number which is linked with your Aadhaar card, you may got an OTP. Furnish that OTP and then your return is verified. Your return is filed. There are three modes for verification of return through if you filed your return electronically. Number one is digital sign. Number two is ITRV. And number three is electronic verification code. That is nothing but OTP based on your Aadhaar linked mobile number or bank linked mobile number or DMAT linked mobile number. Then your process is complete. This verification should be done within 30 days of filing return of income. Next. Compulsory e-return. Certain assessees are required to file return of income mandatorily in certain specified mode. It is not a choice whether to opt for paper return or go with digital signature or go with ITRV. In some cases, it is freezed by your CBDT. That means you are supposed to file return of income in particular mode. For example, a company is required to file return of income electronically with the digital sign. There is no choice. The company cannot file paper return. A company cannot file a return with ITRV. A company cannot file a return with EVC. They are required to file, they are mandatory, it is mandatory to file a company a return through electronic with digital signature mode. A political party on the same line with company, they are mandatorily required to file it electronically with digital sign. A firm, LLP, individual and HUF, a partnership firm, LLP, individual and HUF, they are required to file return of income electronically with digital sign. This is mandatory if their books of accounts are required to be audited under section 44AB, that is tax audit. If tax audit is applicable on a partnership firm, LLP, individual or HUF, then they are supposed to file return of income electronically with digital sign. There is no choice for them to file return of income in any other mode. In case of individual, only individual, read it only individual. If that individual, age of that individual is 80 years or more, his income does not more than 5 lakh, he is not claiming any refund in the return, and he is filing return of income in ITR 1 and ITR 4. In that situation, he can file return of income in any mode. He can file return of income in any of the given mode, that out of this 4 mode, he may choose, he may opt for any mode for filing return income. What are the criteria? His age 80 years or more, his income does not exceed 5 lakh, no refund, and he is filing return of income in ITR 1 or ITR 4. In that situation, he may file return of income either of the mode available to him. For any other person, they can file return of income in any mode but other than paper mode. That means they are required to file return of income electronically. Verification may be through digital sign, maybe through ITRV, maybe through EVC code, but it should be electronic return. It should not be paper return. Furthermore, if a person is claiming relief under section DT, relief under 90, 90A or 91, that is DTA relief, in that situation, the return should not be a paper return. If a person mandatorily required to file return due to assets located outside India, they are supposed to file return of income electronically. Paper return is not possible in case of this type of person. Is it clear? Any question, any query? Any question, any query till now? Anyone? When tax audit is applicable? Any idea? In case of an individual, when tax audit is applicable? Suppose I'm an individual, I'm running a business, my turnover is 1 crore 50 lakh. Am I required to file return of income electronically with digital sign? Am I required to file return of income digitally with electronic sign? It is mandatory to file my return of income in this mode. The answer is no or yes. If tax audit is applicable, then I'm required to file my return of income through a digital signature. If tax audit is not applicable, then it may be through digital signature, it may be verified through digital signature or electronic return with ITRV or electronic return with EVC code. So question arise whether at the turnover of 1 crore 50 lakh, am I required to get my books of accounts audited? What is your opinion? What is your opinion? Anyone? If my turnover is 1.5 crore, in that situation, 44 AD is available to me. That means presumptive section is available to me. I may offer my income under section 44 AD. That means if I'm offering my income considering section 44 AD, in that situation, audit is not required. Audit is not applicable on me. Hence, I can file my return of income electronically with or without digital signature, but it may be verified through digital signature or through EVC code or through ITRB. However, if my turnover is more than, however, if my turnover is more than, say, 12 crore is my turnover, in that situation, I'm supposed to file return of income mandatorily through, I'm required to file return of income mandatorily through digital signature. Done. Nitaji, it is not tax audit is for 2 crore above. No, no, it is not the situation. If my turnover is 1.5 crore and I'm not offering my income under Section 44 AD, then in that situation, my accounts are required to be audited under Section 44 AB. The threshold limit for tax audit applicability is 1 crore. Don't forget about this one. 1 crore, sometime 10 crore. And if 44 AD is applicable, 44 AD is available for me up to turnover of rupees 2 crore. But that doesn't mean up to 2 crore, my accounts are not required to be audited. No. If I am not offering my income under Section 44 AD, then tax audit is applicable. Done. Due date for filing return of income. A return is required to be filed by you. The return is required to be filed within due date of your prescribed due date. What are the prescribed due date? There are 3 due dates: 31st July, 31st October, and 30th November of the assessment year. If you are required to get your books of accounts audited under Section 92E, that is transfer pricing provision, is applicable, and you are required to get an audit report from a chartered accountant under Section 92E. In that situation, your due date of filing return of income is 30th November. If your books of accounts are required to be audited under any law, including tax audit, but you are not supposed to obtain report under Section 92E, in that situation, 31st October. If audit is not required, then 31st July. Basically, there are 3 dates. Basically, there are 3 dates. Audit required, audit is not required. The due date is 31st July. Audit is required. Then ask yourself which audit is required. Under Section 92E, the due date is 30th November. Other audit, 31st October. Further, if Mr. X is a partner, if Mr. X is a partner in a partnership firm, which is required to, which is covered under tax audit. That means X is a partner of XYZ and company. The turnover of this is, say, 20 crore. So they are required to get books of accounts audited. However, tax audit is not applicable in case of Mr. X, an individual. He is a partner in XYZ and company. The accounts of XYZ and company is required to be audited under Section 44 AB because their turnover exceeds 20 crore. So in that situation, the tax, since XYZ company is supposed to get books of accounts audited, their due date for filing return of income is 31st October. Tell me one thing. Is it possible for Mr. X to finalize their books of accounts or their income without finalization of accounts of XYZ and company? Is it possible for Mr. X to finalize their computation without finalizing computation of XYZ and company? Because share of profit is required to be considered in the return of Mr. X. Remuneration to partner, interest to partner are required to be considered in the computation of Mr. X, which is totally depending on income of XYZ and company. So unless and until financial of XYZ and company are not settled, till then Mr. X, being a partner in that concern, are not able to finalize their books of accounts. So in this situation, the act suggests that if Mr. X, even though his books of accounts are not required to be audited, but since he's a partner in a concern in which audit is applicable, henceforth, accordingly, Mr. X, the due date of filing return of income in case of Mr. X is also extended to 31st October or 30th November as the case may be. Done. That means if Mr. X is a partner in XYZ and company, then the due date of Mr. X, the due date for filing return of income in case of Mr. X also depends on the due date of filing return of income of XYZ and company. If the due date for filing return of income in case of XYZ and company is 31st October, then the due date for filing return of income in case of Mr. X is also extended up to 31st October, even though audit is not required in case of Mr. X. Audit is not required for Mr. X, but his due date of filing return of income is extended up to the due date of filing return of income of their partnership firm. Similarly, some part of India where Portuguese civil rule is applicable, Portuguese civil code is applicable, where the income of husband and wife are considered together and then 50-50% is made. In those situations, suppose Portuguese civil code is applicable on Mr. X. In that situation, the due date of return, the due date of filing return of income of Mrs. X is also governed by the due date applicable on Mr. X. That means if Mr. X is a partner of XYZ and company, the due date for filing return of income in case of XYZ and company is 31st October. The due date for filing return for Mr. X is also 31st October. And if Mr. X is governed by Portuguese civil code, the due date for filing return of Mrs. X also became 31st October. However, if Portuguese civil code is not applicable on this family, in that situation, considering all other conditions, the due date for file return of income in case of Mrs. X would be 31st July. Is it clear? If Portuguese civil code is applicable, then due date for Mrs. X is also 31st October. If Portuguese civil code is not applicable, then 31st July, provided she is not partner or another audit is not applicable in her case. Done. Any other question? Do I have is it clear? Is it clear? Tell me, suppose Neeta ji is earning salary income amounting to rupees 65 lakh. Neeta ji is an employee of X Limited. Salary income rupees 65 lakh. Tell me in which ITR she is supposed to file return of income and what is the due date of filing return of income in case of Neeta ji. What is the due date of filing return of income in case of Neeta ji? If her salary income is 65 lakh, she is getting salary from X Limited. The turnover of X Limited is 400 crore rupees. Tell me in which ITR Neeta ji is supposed to file return of income and what is the due date for filing return of income in her case. Due date, Neeta ji is suggesting since salary income is more than 65 lakh, that is total income would exceed 50 lakh. So ITR 2 is applicable. What should be the due date? What should be the due date? What should be the due date? 31st July or 31st October? The audit of X Limited, the audit in case of X Limited is applicable because their turnover is 400 crore. What should be the due date of for filing return of income in case of Neeta's income? Even though the employer turnover is more than 10 crore or 1 crore, that is tax audit is applicable. Salaried employee are not get these advantages. The salaried employee are required to file their return of income by 31st July, irrespective of size of their salary. Suppose Nitaji's salary is 7 crore. In that situation, what is the due date? If salary income of Nitaji is 7 crore, in that situation, what should be the due date? Again, 31st July. That means irrespective of size of your salary income or house property income or other sources or capital gain, your return filing date is 31st July. Unless and until you do not have business income, business or professional income, then your ITR filing is and due date of filing return of income is 31st July. If you have income under the head PGBP, then only analyze whether audit is applicable or audit is not applicable. If audit is not applicable, then 31st July, provided you are not a partner in this type of person. Audit is applicable. Which audit is applicable? If transfer pricing audit is applicable, 30th November. If transfer pricing audit is not applicable, 31st October. Done. Clear? Is it clear to all? Clear? Give me 1 minute break. I'm giving 1 minute break. We are starting again within 1 minute. Okay. Welcome back. Now, belated return. What do you mean by belated return? Belated return. What do you mean by belated return? Any idea? If an assessee fails to file return of income within due date and then he is filing return of income, then this is known as belated return. Is it possible to file belated return after 5 years or 2 years? Is it possible? No. You can't file a return of income beyond certain dates. Ideally, you are required to file return of income within due date. In any circumstances, if you fail to furnish your return of income within due date, then you are supposed to file return of income within certain period. It is not like that. It is open up to 5 years, 10 years. Not like this. You cannot file return of income and within endless period. There is some cutoff period that is 31st December of the assessment year. You cannot file your return on income beyond 31st December of the relevant assessment year. That means 31st December is the last date for filing return of income. If you fail to furnish your return of income within 31st December, you cannot file your return of income for that particular year. However, from ITR-U, that is updated return is possible. I'm not going into that. Ideal situation is that within 31st December, if you fail to furnish return of income, then you cannot file return of income after that point of time. One rider are there. If before 31st December, your assessment is completed by assessing officer, then you cannot file return of income beyond the date of completion of assessment. Upper cap is 31st December. If your assessing officer completed your assessment, say on 30th November of the assessment year, or say 25th January 2024, and here 2023. In that situation, in first situation, if your assessing officer complete your assessment order before 31st December, say on 30th November, in that situation, the date which is earlier is the last date for filing return of income. In this situation, you cannot file your return of income beyond 30th November 2023. In another situation where assessment is completed by 25th January 2024, in that situation, maximum delay is possible up to 31st December 2023. That means if a person fails to file return of income within due date, he may file return belatedly. However, assessee may file belated return before 31st December of the relevant assessment year or before the completion of the assessment, whichever is earlier. Here, what are the consequences of belated return? If a person files a return belatedly, then what would be the consequences? Anyone? What are the consequences? First consequences, he is liable to pay interest under section 234A. He is liable to pay interest under section 234A if he fails to pay tax within the time. Number 2, he is supposed to pay fee under section 234F. He is required to pay fee under section 234F. How much fee is required to pay? If his total income is up to 5 lakh, then he is required to pay rupees 1000 as a late fee. If his income exceed 5 lakh, then he is required to pay 5000 as a late fee. One more thing, suppose my income is 2 lakh. My total income is 2 lakh. I am eligible for deduction under chapter 6A amounting to rupees 25,000. I failed to file my return of income within due date. Finally, I filed my return of income on 2nd December 2023. Let me know what should be the amount of late fee under section 234F applicable on me. Please suggest what is the fee under section 234F I am liable to pay. Is it 1000? Is it 5000? Or is it something else? Anyone? Neetaji, Andal? Neetaji, what should be the amount of late fee I am liable to pay? 1000, 5000 or any other thing, any other amount? In this situation, I'm not liable to pay any late fee. In this situation, provision of section 234F is not applicable on me. Why it is not applicable on me? Technically, I'm not supposed to file return of income mandatorily. My gross total income, my income before deduction under Chapter 6A is within basic exemption limit. Technically, the provision of filing return of income is not applicable on me mandatorily. In that situation, the provision of late fee is not applicable on me. However, in this situation, my total income is 3 lakh and deduction under Chapter 6A is 25,000. In that situation, what should be the late fee? In that situation, I am required to pay 1,000 as late fee. In this situation, I am required to pay 1,000 as late fee. Nitaji, your answer is wrong. Belated return up to 31st 12. No. If it is after due date, I am supposed to pay late fee under section 224F. Since my return of income is on after due date, that is 31st July or 31st October or 30th November, I am liable to pay interest under section 234A as well as fee under section 234F. In this situation, I'm supposed to file return of income mandatorily, and I file my return of income after due date. I am liable to pay late fee of rupees 1,000. Is it clear? Is it clear? Late fee is applicable if you file return of income after due date. If you are required to file return of income mandatorily and you are filing return of income beyond due date, then you are supposed to file return. You're supposed to pay late fee of under section 224F. And now calculation depending on your income, you are required to pay late fee. If your income, total income, does not exceed 5 lakh, then your late fee amount is 1,000. And if your income, total income exceeds 5 lakh, then 5,000. Clear? Is it clear? Any other consequences of filing belated return? Two consequences I suggested: interest, fee. Any other consequences for filing belated return? Anyone? Any other consequences? Or there are no other consequences? Two more consequences are there. Two more consequences are there for filing belated return. Third one. Two we already discussed. Third one. Do you remember section 80 IA, IB, IAC, etc.? Do you remember deduction available under section 80 IA, IB, IAC, IBA, etc., etc.? Anyone? Anyone? Do you remember that section 80 IA, IB, etc.? The common condition for claiming deduction that is related to your profit of the business, that is linked with profit of the business, is return should be furnished within due date. If you fails to file return of income within due date, you are not eligible for deduction under section 80 IA, IB, IC, etc. That is, profit linked deductions are not available to you. However, 80C is available, 80D is available, but profit linked deductions are not available to you. Is it clear? That means you are not eligible for claiming deduction under section 80 IA, 80 IB, IC, etc., etc. And number next consequences is carry forward of losses is not possible. Carry forward of losses, certain losses cannot be carried forward. It is not a generalized statement. Certain losses are not supposed to be carried forward. These are the four consequences you may face if you file return of income belatedly after due date. Is it clear? Is it clear to all? Nitaji? Andal? Four consequences are there. You may be liable to pay interest under section 234A. You may be liable to pay fee under section 234F. Profit linked deductions are not available to you. And Certain losses you cannot carry forward. Done. One more question in my mind. If you read this slide properly, assessee may file such return before 31st December of the relevant assessment year or before completion of assessment. Here bracket under section 144 I have mentioned. What is 144? What is 144? Assessment under section 144. What is assessment under section 144? And why I am specifically mentioning 144? Here, student, try to understand the assessment, the provision of assessment. After filing return of income, what are the procedure? Intimation will be there. Then scrutiny assessment is there. And best judgment assessment is there. There are three types are possible: intimation, scrutiny assessment, and best judgment assessment. One example, it is a very poor example, but for understanding, it is a very good example. Suppose you are appearing in your exam for 2023, December 2023. There are two possibilities. You submit your answer script to the examination examiner. You did not submitted your answer script. Tell me, if you did not submitted your answer script or you did not appear in exam, what will be your result? What will be your result? If you fails to submit your answer script, then what would be the result? Surely it is fail. Surely it is result is fail. Is it possible to do your examiner? Is it in position to verify your marks? If you did not submit your return of income, it is possible to check your answer script? No. It is not possible for your examiner to check your answer script if you did not furnish or if you did not appear in your examination. Agree with me or not agree with me? Agree with me or not? Similarly, the intimation and scrutiny assessment is only possible if you furnish return of income. Intimation and scrutiny assessment is possible only if you furnish your return of income. If you fails to furnish your return of income, I'm supposed to scrutinize your return, but what to scrutinize? There is no answer script. There is no return. What I'm supposed to scrutinize? Nothing. So the assessment, scrutiny assessment and intimation is not possible without filing your return of income. The only possible assessment is best judgment assessment. The only possible assessment is best judgment assessment. That is the reason here in the bracket I mentioned assessment under section 144. That is best judgment assessment. Apart from best judgment assessment, no assessment is possible without filing your return of income. Since you are filing belated return, that denotes if you did not file your return up to the completion of assessment, that denotes the only possible assessment your assessing officer is doing best judgment assessment. That's why it is mentioned. Is it clear? Is it clear? assessment, that is intimation and scrutiny, is possible only if you file your return of income. Now comes to loss return. What do you mean by loss return? Am I required to file loss return? Loss return. Ideally, a company, a partnership, a firm, or LLP are required to file return of income within due date. Ideally, a company, partnership firm, LLP are required to file return of income mandatorily, irrespective of size of their income. However, however, an individual, an HUF, is supposed to file return of income if their gross total income without considering deduction under 54 series exceed basic exemption limit. Suppose in case of negative income, in case of an individual having negative income, he is not required to file return of income mandatorily because his income is negative. That denotes basic exemption limit does not process, does not pass through. His income does not process basic exemption limit. He is not required to file return of income. What happened? Suppose in year one, I'm trying to giving you understanding very simple and very practical way. I'm not just reading the slides. I'm explaining the provision, the reason behind the provision. I think it is okay to you, okay to all of you. I'm not reading just mere reading of the slide. That is you already done. I'm trying to provide some understanding of the section. What was the consequence? Why these provisions are there? In year one, Mr. X suffer business loss of rupees, say 10 lakh. He is not supposed to file return of income because his total income, gross total income does not exceed basic exemption limit. So he did not file return of income. No return filed. In year two, his income from business is say 12 lakh, say 15 lakh. In this 15 lakh, he adjusted this 10 lakh and stating his income of 5 lakh, he filed return of income. Now, assessing officer scrutinize his return. His 15 lakh is okay, but how could he calculate this 10 lakh loss? How could he ensure that the figure of loss are perfect? Because in last year he did not file return of income, citing the reason that I'm not liable to file return of income because my gross total income does not exceed 5 basic exemption limit. In this situation, assessing officer is bound to follow the figure provided by him. It may be 10 lakh, it may be 1 crore. This is the situation where your income tax department required to check the figure of the losses because this have effect on future years income. So that considering this theory in mind, they created this provision 139(3), stating that business loss, speculative or non-speculative, capital loss, loss from owning and maintaining race horses, and loss from business specified under section 35 AD. What is 35 AD? So, 35 AD applicable on cross-country pipelines, cold storage, etc., where deduction are available, 100% deductions are available for your capital expenditures, no depreciation. These 4 type of losses you cannot carry forward if you fails to file return of income within the due date. These 4 type of losses you cannot carry forward if you fails to file your return of income within the due date of filing return of income. If you file your return of income within due date, that will enable your assessing officer to justify, to verify your claim of losses. That's why this provision are there. However, loss under the head income from house property, Unabsorbed depreciation. Unabsorbed depreciation can be carried forward irrespective of the fact you fails to file return of income within the due date or you did not file any return of income. That means these two type of losses can be carried forward irrespective of the fact you fails to file return of income within due date or you did not file any return of income. However, these four type of losses you cannot carry forward if you fails to furnish your return of income within due date. Now, few question in my mind. Year one, Mr. X, business income is negative 7 lakh. Income from house property is rupees, say 6 lakh. I'm making it 6 lakh. He furnished his return of income on 3rd December 2023. Let me know what should be his income and what should be the consequences of filing belated return. Please. What should be his income for year one? Or any losses are required to be carried forward? Please let me know. Nitaji, please reply. Nitaji, please reply. What should be the total income for year one? And Andal is saying 6 lakh is income. Dear Andalji, the restrictions are for carry forward. The restrictions are not for set off. Be careful. Set off is possible. The restriction is for carry forward of losses. Since set off is possible, income from house property, the loss under the head business, PGBP can be adjusted with income from house property. It is possible, but that means their income would be zero and loss of rupees 1 lakh, which is supposed to be carry forward, since return is furnished after due date. This carry forward is not possible. Carry forward of loss is not possible. Set off is possible. Clear? Number two situation. Year one, number two situation. Situation number two. Mr. X, business income loss 7 lakh. Salary income 6 lakh. Filed return of income on 3rd December 2023. Now, what should be his total income and what is the fate of losses? Andalji, no, set off is possible. The restriction is only for carry forward. You can set off your losses. So 6 lakh income out of 7 lakh losses, 6 lakh is supposed to be adjusted. Now in this situation, what should be the loss? What should be the total income and what is the required to be carried forward? Please let me know. Andalji, is it clear? Set off is possible. In this situation, his total income would be 6 lakh and losses of 7 lakh are not supposed to be carried forward. In this situation, income would be 6 lakh because here the provision of set off are there. Business loss cannot be adjusted with your salary income. So this total income would be 6 lakh and the remaining loss of 7 lakh you cannot carry forward. No carry forward. Done. Situation number 3. Year 1, Mr. X, business loss 7 lakh, income from other sources 2 lakh. Return is filed on say 1st June 2023. What will be the consequences? What will be the consequences? In that situation, can I say that there is a loss of rupees 5 lakh which is supposed to be carry forward? Carry forward is possible because return is furnished within due date. So loss of rupees 5 lakh is required to be carry forward. 5 lakh loss carry forward to the next year. In year 2, what happened? There is a business loss of rupees 6 lakh, income from other sources 3 lakh, income from other sources 3 lakh, return is filed on say 2nd December 2023. Now what will be the result? Now what will be the result? Please let me know. And I'm adding one more year. Year 3. Business income. Now the loss is converted into income. In year 3, he earned 10 lakh profit. Let me know what should be the total income after offsetting the losses. Now, what should be the total income after set off and carry forward for year number 3? बोलिए sir. Please let me know. Please reply. Year number 3. In year 3, here in year number 2, 3 lakh would be adjusted and remaining 3 lakh would be lapsed. This would be lapsed, no carry forward. What will be the fate of this 5 lakh? It will be carry forward to year number 3 or not? Can I adjust this 5 lakh loss with this business income? Yes, I can adjust this loss of 5 lakh belonging to first year. My total income would be 5 lakh. I cannot adjust this 3 lakh. This losses cannot be carried forward, but losses relating to year 1 can be carried forward. Irrespective of the fact, return of year number 2 was filed belatedly. Irrespective of the fact, return for year number 2 filed belatedly, the loss pertaining to year 1 can be adjusted in year number 3. Is it clear? Is it clear? That means once the return should be filed within due date, that condition is applicable only to the year in which the loss was incurred. Once the return is filed timely, subsequent year return, if you fails to furnish within due date, it will not affect your situation of carry forward. Is it clear? Clear? Now, revised return. What do you mean by revised return? What do you mean by revised return? If you discover any omission or wrong statement in the return previously filed by you for that particular year, you can revise your return under section 139(5). You can revise your return under section 139(5) within the same period is there. Before assessee may file the revised return before 31st December of the relevant assessment year or before completion of regular assessment. What is the difference in belated return? I have mentioned it is before completion of assessment under section 144. But in revised return, I mentioned before completion of regular assessment. Why regular assessment I used? Whichever is earlier. That means in ideal situation, you may revise your return of income which is filed earlier up to 31st December 2023, your assessment year 23-24. If assessment is completed, assessment is done on 30th November 2023 or assessment is done on 31st January 2024. If assessment is done on 30th November 2023, you can revise your return up to 30th November 2023. If assessment is done by 31st January 2024, you can revise your return by 31st December 2023. I believe it is clear to all. The same timeline are there relating to belated assessment. However, one change are there. Here I'm using the word regular assessment. I'm not using the assessment under section 144. Dear student, regular assessment means scrutiny assessment or best judgment assessment. If you file your return of income, there are three possibility: intimation, scrutiny, and best judgment assessment. Intimation is mere an intimation. It is not treated as an assessment. The regular assessment are scrutiny or best judgment assessment. You can file return of income even though you got intimation, because intimation is not a regular assessment. Suppose intimation is governed by section 143(1). Scrutiny assessment is governed by section 143(2), and best judgment assessment is governed by 144. Ideally, what happened in generally nowadays, if you are a salaried employee, if you file your return of income on say 31st July 2023, within couple of days, you may get intimation. Sometime on the same day, you may get intimation under section 143(1). That means you cannot revise your return. If you consider intimation as an assessment, then you cannot revise your return furthermore. However, this is not the intention of the law. Intimation cannot be considered as a regular assessment. So if till scrutiny assessment or best judgment assessment or 31st December, whichever is earlier, you can revise your return n number of time. You can revise your return n number of time without obtaining any permission, any approval from any authority. Is it clear? Suppose Mr. X filed his return of income on 7th November 2023. On 2nd December 2023, he discovered a wrong statement in the return, which is bona fide in nature. Can he revise his return? The answer is yes. The return can be revised even though the original return was belated return, even though the original return was lost return, even though the original return was filed within due date. Each and every type of return you can revise n number of time within the given time frame. You are not required to get any approval. You don't require to get any permission for revising your income, revising your return. One more thing. the revised return should be complete in all respect. It is not like this. Suppose in original return furnished on 2nd August 2023, Mr. X furnished the detail of salary amounting to rupees 10 lakh, but he fails to furnish his income from other sources from saving bank account, say rupees 15,000. Now, this was not mentioned in original return filed by him. He discovered this mistake, and so on 2nd December 2023, he is filing revised return. In the revised return, what he is supposed to be filed? Is he required to furnish salary detail again, or only detail from income from other sources? Or it is whether he is supposed to furnish both information, this is the option, or he is supposed to provide only income from other sources, because salary information relating to his salary income is already furnished in original return. What is your take? He is required to furnish information relating to his salary income as well as income from other sources, or he is supposed to furnish information relating to his income from other sources in the revised return. What is your take? And I'll do the same. The 31st December is the same. 3 months before the end of the relevant assessment year, it is same, comes to 31st December. Now, tell me which is the correct answer. Number one or number two? Option one or option two? If he filing revised return, in the revised return, what he is supposed to file? The information relating to salary as well as income from other sources, or only he will provide information relating to income from other sources, stating that considering my original return, add this one also. Here, students, the revised return should be complete in all respects. He cannot choose only relating to information regarding this income from other source. Even though information relating to salary has already been furnished, if he is revising return, that return should be complete. That should not be like additional information. The return should be complete in all respect. That means he is supposed to provide information relating to salary as well as information relating to income from other sources. He cannot furnish only information relating to income from other sources, justifying that my information relating to salary is already been furnished in original return. This is not the correct way to file or a revised return. What happened? Once you filed your revised return, they will destroy original return. Only consider your revised return. So revised return should be complete in all respect. Whatever information you are supposed to furnish, that should be included. Even though it is already furnished by you in the original return, you are supposed to furnish it again in your revised return. Is it clear? Is it clear? Very correct. Now, replacement of original return we already understood. Revision of revised return. Can you revise your revised return? Yes, sir. You can revise your return n number of time within given of time. Even a revised return filed by you can also be revised by you. Revision of belated or lost return is possible? Yes, sir, it is possible. Earlier, revision of belated return was not possible. Now, in last 3 years, it is possible. Belated return can also be revised within the given time frame of 31st December or before completion of regular assessment, whichever is earlier. Clear? Is it clear? Defective return. What do you mean by defective return? What do you mean by defective return? What do you mean by defective return? Defective return means if certain information you are required to provide in your return of income, but you fails to provide that information. You are required to pay tax beforehand, before filing return of income, but you fails to pay tax beforehand. or you are supposed to provide certain information or certain documents along with return of income. In that situation, or certain information are contradictory in the return itself. In all this situation, your return may be considered as defective. Be careful, nowadays paperless return are required to be filed. In that situation, you are not supposed to submit the required document along with your return of income. You are supposed to keep all them handy. Whenever they required, you are supposed to furnish those documents. You are supposed to submit those documents. However, if you are supposed to pay tax before return, but you fails to pay tax and file your return of income, or certain information which are required to be given in the return of income you did not furnish, or your information in the return itself is contradictory, in those situations, your return is considered as defective. If a return is defective, if a return is considered as defective, your income tax officer will intimate you that there is a defect in your return. Please rectify this defect within given period of time. Generally nowadays 30 days are provided. And once if you rectify the defect, within the given time, rectify the defect within time or extended by your income tax officer, then it is considered as return. Proper return has been filed and law will follow. And if you fail to rectify, in that situation, we will consider that you did not file any return of income. We will consider the return filed by you as an invalid return. We will consider that return as an invalid return, and if it is considered as invalid return, that means the consequences is that your return are not filed by you. Any return, you did not file any return of income, and then whatever the consequences for not filing of return of income should be followed. Is it clear? Is it clear? Verification of return. Suppose we create drafted an agreement. We take a printout on the stamp paper of that agreement, but we did not sign that agreement. Is it valid agreement? Is it a valid agreement? We take a printout of an agreement on a stamp paper, but we did not sign that agreement. Is it a valid agreement? Is it enforceable? Surely no. Surely no, it is not. Without signature of an agreement, that agreement is nothing. Similarly, if you are filing return of income, but you are not verifying that return, earlier the provision states that signature is required. Now, since technological changes, signature is not possible in case of e-return. So they use the word verification of return. Any return filed by you without verification are not considered as a return filed by you. Then who is required to verify the return? In that case, in case of an individual himself is required to verify the return. However, if individual is not in India, is absent from India, again, in this situation, individual himself is required to verify the return. However, if it is not possible for him, in that situation, any authorized person are required to verify the return of income. Where individual is mentally incapacitated, in that situation, the guardian of that individual or any other person who is competent to act on his behalf is required to verify the return. Where by any other reason it is not possible for him to verify the return, in that situation, any person authorized by that individual is supposed to verify the return. In case of HUF, Karta is required to verify the return. If it is not possible for him, because he is absent from India or he is mentally incapacitated. In that situation, any adult member of the family may verify the return. In case of partnership firm, in general, managing partner is required to verify the return. However, it is not possible for him or there is no managing partner. In that situation, any adult partner may verify the return. In case of LLP, in general, designated partner is required to verify. However, it is not possible for him to verify, then any partner or any other prescribed person may verify the return. In case of local authority, principal officer is required to verify. In case of political party, chief executive officer is supposed to verify the return. Company, in general, MD, that is managing director, is required to verify the return. If due to any reason it is not possible for MD to verify or there is no MD, in that situation, any director or any other prescribed person are supposed to verify the return. In case the company are under insolvency and bankruptcy court, then that insolvency professional are required to verify the return. In case of non-resident company, a person having valid power of attorney is supposed to verify the return. In case company are under process of winding up, the liquidator of the company is supposed to verify. In case the company, in case of government company, principal officer of the company is supposed to verify the return. Any other association, any member of principal officer or any other case or any person who are competent to act is supposed to verify the return of income. Is it clear? Is it clear? Any question, any query? Anyone have any question, any query? Anyone have any question, any query? Neetaji, Andalji? Hopefully you enjoyed the session. In case there is no query, can I proceed to next chapter or? Okay. Hopefully it will be helpful to you. Assessment procedure. First of all, who assessed your income? First of all, who assessed your income? Who will assess your income? Income tax department or someone else? Will who will update? Who will assess your income? First of all, it is you. You are supposed to assess your income. That is known as self-assessment, which is governed under Section 140A. Unless and until you self-assessed yourself, how could you file your return of income? So first of all, you are supposed to assess your income under Section 140A. After your assessment, you may or may not file your return of income. Then the other proceedings, that is intimation, regular assessment, income stepping assessment comes into play. What do you mean by self-assessment? Updated return we will discuss after completion of assessment procedure. What do you mean by self-assessment? Section 140A. Assessee himself is required to assess his income and tax liability, and accordingly he is supposed to pay that tax liability beforehand, that is before filing return of income. If your self-assessment suggests that your tax liability is 1 lakh You are liable to pay interest, say rupees 10,000. You are liable to pay fee of rupees 5,000. Altogether, you are liable to pay 1,15,000. But while filing return of income, you paid only 1 lakh as self-assessment tax. In that situation, what will be the order of arrangement, order of the adjustment? In that situation, your act is suggesting that in any circumstances, first, whatever payment made by you shall be adjusted with interest and fee, and remaining, that means 15,000 is adjusted with your other levy, that is interest and fee, and remaining 85,000 shall be adjusted against your principal tax liability. We will say that 15,000 tax is still due from you. We cannot say that interest and fee of rupees 15,000 is due and your tax is fully paid. No, we will say 15,000 of tax is due. Why? Why? Why this type of arrangement has been made? Because we will charge interest under section 234 ABC on tax amount. There is no provision in the income tax law to charge interest on delayed payment of interest. There is no provision in income tax law to levy interest on delayed payment of fee. We are charging interest on simple interest rate basis. Simple interest calculation is applicable. So there is compounding interest is not possible. To mitigate this situation, what they prescribed whenever you are making payment of the taxation, first of all we will adjust this tax amount, the payment amount, against interest and fees, and remaining portion, if there is any remaining amount, that would be adjusted against your principal amount of taxation, and remaining the balance is still due. The due amount is your tax amount. Is it clear? If any person fails to pay self-assessment tax before filing return of income, he will be treated as default, assessee in default, and accordingly consequences will be applicable on him. Now, after self-assessment, you file your return of income, then the question, then intimation is is there. If you did not file your return of income, intimation is not possible. What is intimation? Whatever you filed, your income tax department will accept, barring few adjustments. Unless and until there is prima facie mistake in your filing, that means arithmetical mistake. 2 plus 2 equal to 5. You done 2 plus 2 equal to 5. Is there any argument? This is mistake. Is there any doubt? This is mistake. 2 plus 2 will never be 5. It will be only 4. This type of mistakes, you claim TDS amount, which is not reflecting in your 26 ES. You are claiming certain losses which are supposed to be carried forward by you in next year, but on record you furnish the return of that year belatedly. Is it possible to offset that losses? No. You are claiming deduction under section 80C amounting to rupees 2 lakh. Is there any debate or any doubt regarding these mistakes? This type of mistakes will be checked, will be rectified, and whatever information you have provided, we will accept. We will not raise any question. Say you are saying your salary income is 10 lakh, we will accept. Okay, fine. Your business income is 15 lakh. We will accept your business income is 15 lakh. Unless and until prima facie there is certain which mistakes or which are apparent from the return itself without gathering information from outsider. If it is apparent, then those type of mistakes will be rectified, and your return is processed for intimation. If something is refundable to you, then we will proceed for refund, and if something more we are supposed to receive from you, then we will send a demand notice to you. Please pay this much of amount. Intimation is required to be sent within 9 months from the end of the relevant assessment year. For your assessment year, maximum time for for sending intimation is 9 months from the end of the relevant assessment year, that is 31st December 2024. An intimation cannot be sent beyond this 31st December 2024, 9 months from the end of the relevant assessment year. Is it clear? Is it clear? Any other any question, any query from this segment till now? Any query? Okay. So today I am concluding this session. Tomorrow we will meet with assessment procedure. Updated return we will do after completion of interest. After completion of interest, we will go with updated return because there is a consequences on interest provision. Unless and until you go with an interest provision, you can't top up with updated return provision. What is updated return? That is ITRU. You may file your return of income beyond 31st December up to 2 assessment year. Uh, However, you are supposed to pay additional amount of tax amounting to 25% additional liability will be there in case if you file your updated return within 1 year, and 50% of your tax liability if you file your return of income after 12 months of that is in the second assessment year. That means suppose your tax liability is 10 lakh and you are filing ITRU, that is updated return, in the first 12 months after end of that your assessment year. In that situation, you are required to pay 2,50,000 extra as an additional tax. Then only ITRU is possible. And if you are paying after 12 months, then 50%, that is 5 lakh, you are supposed to pay additionally. In any circumstances, refund is not available to you under ITRU if you are filing ITRU. The department has prepared, the income tax department has made this return for more collection. It is not beneficial to you. It is benefit for the benefit of income tax department. Is it clear? Okay. Now I'm concluding this session. Tomorrow we will meet again at 3 o'clock.
Thank
Hopefully
you,
the
sir.
session, you enjoy the session.
एक दो जितना भी आप सिलेक्ट करेंगे मुझे एक देना।
Hopefully you enjoy the session. Thank you.
Thank you, sir.